Hello, and welcome to this webinar on energy credit, brought to you by Energy Risk in association with Enuit. I'm Stella Farrington, Head of Content for Energy Risk, and I'm joined today by 4 energy experts who are going to discuss the challenging credit environment facing energy firms today and give their insights into how it might best be navigated. So joining me today are Glenn Mackey, the Chief Risk and Procurement Officer at NRG Energy, Scott Lapierre, petrophysicist and founder of Shale Specialists, Roderick Austin, a managing partner at CubeLogic, and Robert Belinsky, the Vice President of Services at Enuit. Thanks very much to all of you for joining us. So today our focus is going to be You're welcome. So today our focus is going to be mainly on the US, and next week we'll be running a second webinar which will have a more Asia-based focus. So we want this webinar to be very interactive, and we invite you to ask questions of our panelists at any time. There is a question box on your screen, so simply fill your question in there, and I'll be putting those questions to the team at the end. So today we're going to be discussing probably 4 main areas. First of all, how the credit requirements of banks are changing and how that's impacting energy sector lending to the energy sector. Secondly, will be the impact of the energy transition on the credit worthiness of energy firms. And then taking those sort of external situations, we'll then be looking at what challenges that brings to risk officers and credit risk officers in terms of processes and procedures, how to gain an insight into your own credit situation by, really understanding the credit situation of your suppliers, your clients, and your trading counterparties. So looking along the supply chain, and then looking at how the risk officer, or the credit risk officer, or the trader can gain a holistic picture of the company's credit risk. So we wanted to kick off by asking the audience a question, if we may, please. And because we'd like to find out what you consider your biggest credit risk at this time. So if we could have that question up on the screen, I believe it's up there now. And what's really behind that question is, obviously the fact that energy is a very extremely capital-intensive industry, and access to credit is essential. But it's something that has become significantly more constrained over time in recent years. And this is a situation that's caused both by what's happening in the banking sector itself, and also the energy industry facing an extremely unprecedented situation, really, with the move to the low carbon economy, and the capital markets trying to place capital in order to facilitate that. So if you could get those answers in now, that would be great. And the question we've asked is, what do you believe poses the biggest credit risk to energy firms currently? Is it A, the energy transition, B, lower credit risk appetite from banks, or C, the COVID-19 demand shock, or the global economic downturn? And it looks like some answers are coming in on that now. So I'd like to turn over to Glenn first of all, please. Glenn Mackey, CRO at NRG Energy. Glenn, can you see the answers coming into that question?
Let me just refresh here. I see the question itself. Yes.
So yes, so it looks like there's a lot of answers in now, and it looks like the biggest credit risk at the moment people are finding is the global economic downturn, or fear of that, followed by COVID, and then the energy transition and the credit risk appetite from banks are both tying at the moment as the third and fourth sort of most important risks. So Glenn, could I ask you to comment on those results and tell us what you're finding is the biggest credit risk at NRG?
Sure. For us at NRG, and for most of the industry that is consumer facing in the commercial or industrial sector, or residential market as well, or even in the wholesale markets for various energy commodities. The overall lower appetite from banks has had a substantial implication on our business. So for example, if you think of oil as illustratively, the oil industry, with the reduction in oil prices down below $30 related to some of the disagreements with respect to pricing in the Middle East, has created a situation where banks that have individual exposures of up to $19 billion per bank with a high concentration risk to the energy businesses are facing certain credit issues themselves. And any time that you have a consolidation of capital towards one sector, such as the energy sector, there are derivative and sort of ripple ramifications from that. So when you think of the energy sector, and even just using renewables as an example, the constraints around the ability for banks to provide tax equity or construction financing or back leverage or flipping out of some of these projects has materially, from our perspective, impacted the industry, the developers, and the overall renewable industry as far as the progress on renewable energy from that perspective.
Mm-hmm. And could you give us, could you set this into some context? How challenging does this feel now compared to, years past? Does it feel like a greater challenge, or is it something that's always up there as, a pretty difficult thing to navigate for the energy industry?
I think the energy industry is very, very much accustomed to the cyclical nature of commodity prices. But the combination of lower commodity prices as well as restriction in capital available both in the equity markets, we've seen a deterioration in the overall market capitalization of the sector, and we've seen a tightening in the debt appetite for the energy sector as well. When you combine a lower commodity price situation with a constraint on capital to deploy, a lot of energy companies in the exploitation and exploration sector are very heavily reliant on the ability to fund their drilling and operations from that perspective, as well as build out the infrastructure required across the North American market. And consequently, that constraint in capital tied with lower prices to be able to service the debt and revolve the credit lines that they have is significant and material, and we're seeing that ripple now into industries that are servicing the specific producers themselves in some form or fashion.
Yes, and you talk about that sort of ripple effect, and it's going into industries that serve energy now, and indeed taking the global economy at this time. And interesting actually that the audience chose that the global economic downturn as perhaps the biggest challenge they see. Could I bring Robert into this now? Robert Belinsky at Inuit. Could you talk about what the bigger section, the bigger problem that banks are facing widely? Not just energy, but there's other sectors that are not performing as well at the moment, leading to, more caution when it comes to lending, perhaps. Could it be the case that an energy firm is actually performing pretty well, but is still getting credit lines cut because of the wider situation that's happening now?
No, absolutely. We have seen that in some of our companies who are primarily trading shops that use our software, and they've been sustaining a profit margin throughout this whole market downturn. But they've had banks come to them and say, we're going to reduce your capital or your lines of credit, not because of any risk or exposure that they necessarily have with them, but they're feeling the crunch. And I think Glenn alluded to this a little bit as well, too, is the crunch on the other side of their business. What they may have had a big commercial real estate portfolio, or were involved with some of the airlines or the car rental companies, people who overnight just stop paying down their debt, and so they're feeling a severe capital crunch on another side of their business. So it's had a ripple effect across other areas where they've needed to tighten the reins, if you will. And so many of our customers have gone and have looked at either expanding their portfolio of capital institutions that they deal with, or certainly looking into it because they're concerned if they're tied into one or two large regional banks and they have issues, and that they may end up having problems, not by their own making, but just because they're getting their credit reduced because of the banks having issues.
Yes, thank you. And is that quite a normal way of acting at this time? Is it usual that in times of credit constraints that clients of banks may go to more than one or two providers? I mean, how many providers typically do they use?
They typically, again, referring to like a smaller regional type trading shop, and they may have one or two primary sources of capital, and that suited them fine. But now they definitely are looking at expanding that. And I can't say how it's always gone through every credit cycle, because I think this one is extreme, and abrupt. 6 months ago, I don't think anybody saw this on the horizon, right? And now we're in a situation where 25% of the workforce is either looking for a job or worried about losing their job. So it's a whole new ball game, and so I think everybody is kind of shifting the way they're thinking and how they're approaching some of these topics.
Yes, yeah, absolutely, and interesting that they may be approaching new banks at a time when they perhaps don't present as being part of a very credit-worthy sector, perhaps.
Correct. It's not the best time. Yeah, not the best time to be doing that, but I mean, you're kind of forced into it, and yes, so that's what I refer to, thinking how rethinking how they do some of their business in regards to kind of trying to line this up before they have issues rather than after it happens.
Yes. Okay, thank you. So let's turn now to, I think what might be certainly from Glenn's point of view, something that he's already raised as being, integral to all of this, which is the energy transition. There's so much going on at the moment for energy firms, because obviously COVID-19 created demand for energy, and Robert, as you said, that this was unthinkable a few months ago. Unthinkable that oil prices would go to zero, and negative, and that demand could fall off a cliff so quickly. But it's also true to say that firms were struggling. Some firms were struggling already before that. And so, it'd be interesting to see if people think of this as specifically a COVID issue or as a longer term issue. Because according to the law firm Haynes and Boone, last year, 42 North American oil and gas firms filed for bankruptcy, the largest of them running up a debt of $5 billion. So this is something that happened, way before COVID. Many of these are obviously in the shale industry. That's been one of the hardest hit. So I'd like to bring in at this stage Scott Lapierre, founder and director of Shale Specialists. And Scott, as a founder of a private shale energy company, you sort of understand the way that industry works, and the fact that it, credit is everything there. It's capital intensive, relies on good relations with banks, constant flow of money coming in to set up for the next project, and obviously that relationship is predicated to a great degree on what the company forecasts for its future production. When you were there, you found that there was a physical limit on the shale oil recovery, didn't you? Could you just talk us through very briefly how you found that and what impact that has on reserve-based loans, reserve-based lendings, and the firm's credit worthiness?
Yes, thank you. Leading up to this, I will add the color that the shale industry pre-COVID, we were struggling for a couple of quarters before, towards the end of 19, the last half of 19 and into 20, of course, right before COVID hit. And sort of the main problem we were facing was that we weren't able to accurately forecast reserves. And it turns out that in general, our technologies, which we took from the conventional reservoirs of the past 100 years, which were more like a jar of marbles where the fluid in oil and gas and water can move kind of freely between the marbles, which represent the grains in a sand reservoir or something like that. Well, we switched over to shales, which is actually more like concrete. There's oil in the holes, but it doesn't move until you break the rock open with some hydraulic pressure. But we were using as an industry the techniques that we had developed. A lot of smart people over a lot of years had developed these forecasting techniques and basic reservoir behavior sciences to forecast production going into the new shale revolution. And it turns out that some of the, and this is rather well documented in a series of articles in 2019 written by the Wall Street Journal and others, that basically demonstrated that we weren't, as an industry, not able to forecast accurately. In fact, we were overestimating by a reasonable amount that was impacting investor confidence, and more importantly, it was impacting our industry's ability to generate the returns that we thought we would be able to make to meet the expectations we helped set. So before the COVID, we were struggling, and we were in a recession as a shale industry where capital was being cut tremendously because CapEx deployed last year, 3 years ago, was not being offset by production revenue that was anticipated to offset it. So we were laying off a lot of people. It was really a depressed time in the shale industry going into COVID. And before I started Shale Specialists, I co-founded an exploration company funded by private equity to exploit sort of this mechanism and some of the science that I had discovered that predicted that problem. In terms of there's actually the mechanism that drives the oil to the surface, which most people think we suck the oil out of the ground, and in some small cases we do, but the majority of the 100 million barrels a day that the world produces is pushed to us from pressure within the earth. And it's in my opinion and in my theses, it's the source of that pressure that we got wrong because of the assumptions, the natural assumptions that we were using from our 100 years of working with jars of marbles, so to speak, where the fluids are free to move. And so this theory, which on the nature of the mechanism forcing the oil to the surface, it has two features. One is a positive feature that you can predict recoveries for whole acreage positions and whole corporate portfolios in advance to a better degree of accuracy, but at the same time, it sets up a very significant physical limit to the recoverable oil from shales. And that's sort of, in my perception and in my years of participating and watching this, from the beginning of the shale revolution till today or pre-COVID, this is a significant consideration that the industry needs to make in planning its development activities. Now, I don't mean that the U.S. oil shale revolution is done for, or that we don't have a tremendous gift from nature in the United States. We do have the largest accumulation of hydrocarbons per square mile on the planet, bar none. It's just we need to be better at forecasting how much we can extract, and also be better at economically extracting as much as we can.
Okay, which in turn would avoid some of the situations of the production shortfalls, which the industry has been renowned for. you know, not falling short of some of its estimates,
Exactly.
which then, of course, have an impact on the next round of lending, presumably. And if we could just set this back into the wider context of transition risk, in a sense, perhaps caused by, well, definitely caused by a different issue, but I guess for banks a similar type of outcome, the fact that it all results in demand destruction. And we can see now oil majors coming out and acknowledging that both BP and Shell have, you know, have written down some of the value of their future assets. And this is going to have a big impact, presumably, on the structures financial structures needed in the future. I wonder, could I, at this stage, please bring in Roderick Austin of CubeLogic. How do you see this playing out? And what are some of the sort of changes in financial structures that you're seeing to deal with this?
Sure. Yeah. Thank you, Stella. So, you know, it's a continuation of a point that I think Glenn made a little bit earlier, where we acknowledge that the banks are tightening the credit terms that they're using to lend to industry participants, and this has a cascading effect. You know, it becomes a little bit harder to get access to capital. You know, potentially, you know, to your BP and Shell points, you either have to sell assets or put up more assets as collateral in order to get access to those capital markets. And this has an ability for some firms to hedge, for example, where, you know, they might need more collateral requirements to cover the margins on margin activity that they're doing with the banks. And so you get into this collateral squeeze situation where it's harder to get access to the capital markets for funding, and the access that you do get is there are more constraints placed on those funds. And so your cost of working capital becomes more expensive. And this in turn forces companies to be much more risk averse to using the cash flow of the firm versus the balance sheet of the firm. And so because cash then becomes extremely important, firms want to find alternative ways of doing business and posting collateral. And so one of the big trends that we've seen within the energy credit space, probably over the last 24 months or so, I'd say, is when it started in earnest, is this move away from sort of traditional cash or LC-based collateral, letters of credit-based collateral, which are expensive and obviously tie up cash, to things like surety bonds. Also better securing the accounts receivables of the firm and ensuring that you have a net flow of cash in. And so, you know, other instruments like trade credit insurance policies to secure those ARs is another very popular tool that we see firms using at the moment, all about leveraging the strength of the balance sheet and securing cash, because, you know, while it can take a while for firms to approach a default situation where they're actually filing for Chapter 11 or the equivalent, liquidity crunches will take a firm out of business instantly. And if there's a move against you and you have to post margin and you don't have the cash to post that margin, you are in immediate trouble. So ensuring that you have adequate cash flow and cash on hand to sustain business operations, particularly in the energy space where there's a lot of transactional and trading activity going on, has become an extreme point of sensitivity for firms. And that's one of the trends that we're seeing in the energy credit space right now.
Yeah, thank you. Obviously, when we talk about some of these changes and the transition risk, you know, we're talking about demand destruction. There is obviously the opportunities that are there as well, and there's the rise in renewables is a big piece of that transition movement. Glenn, could I bring you in here to talk a little bit about the credit impact of renewables? It's a double-edged sword in some ways, isn't it? Could you just talk us through NRG's experience here?
Well, I think, you know, generally, the credit exposure to renewables comes in two forms. Acquisition of long-term power purchase agreements and wind purchase agreements, if you will, solar agreements related to the developers that have built and or are operating the renewable facilities. So you've got the wholesale side of it, and then you've got the retail side where essentially you're selling into residential, commercial, and industrial markets. What we've seen is essentially, in the midst of this COVID-19 pandemic, the renewable industry is beginning to ponder, the long-term viability of some of the projects, and specifically around the halt in, some of the global economic activity and sort of the ramifications thereof towards, the long-term viability. Well, there still is viability to the renewable industry. Some of the projects that we've seen in the past year that we've been very comfortable with have the economic viability of those has been challenged, and that in turn creates additional credit exposure to the firms that are either contracting by way of a PPA or taking as an off-taker, taking that and selling it into the commercial and industrial markets that are also being challenged.
Okay, thank you. I think we're going to move on now from this sort of external factors and look at how credit risk officers and heads of trading, credit risk officers, and actually dealing with some of these challenges. So, we're going to turn to look more at the challenge of actually assessing and analysing some of this stuff that's going out there in order to get a picture of your own credit worthiness. And of course, in doing so, a big component of that is going to be sort of trying to get an accurate picture of the credit situation of your suppliers, your clients, and trading counterparties across the whole supply chain. So we're going to start this section with another audience question. Could we put the second question up on the screen, please? And this is going to be asking you what you see as your biggest challenges when it actually comes to addressing and assessing your company's credit risk. So is it A, getting accurate data on counterparties and clients? So this is, do you get that from rating agencies, from company filings? Is it sufficient? Is it proving to be a bottleneck in your credit assessments? B, understanding banks' credit assessments and appetite. So, is it easy, or how challenging is it for you to understand what banks need from you? Is it C, pulling together information from siloed risk systems before analysis can start? And this is something that we talked about in the run-up to this webinar, how a lot of companies have their different sets of clients, their suppliers, their trading counterparties, potentially in different risk systems, on different databases. Is that a problem, pulling all the data together before you can even start the assessment? Or is it D, developing analytics to actually assess your own credit risk? So we should have some answers coming in from them. Could we get those up on the screen now? And I'd like to turn over to Glenn again at this stage. And yes, it looks like getting accurate data on counterparties and clients is coming up fairly high, as well as actually developing the analytics there, 29% there. So Glenn, could you just comment on that and talk about what your biggest challenge is?
Yeah, I would agree with the viewers' analysis there, and I think that actually item A, they're getting accurate data on counterparties and clients, is sort of leads into the challenges around developing analytics to assess the credit. Because if you don't have the data and information on the particular entities, it's very hard to develop the analytics associated with the credit as well. So from our perspective, the challenge comes in two different ways. A lot of the information that is provided by customers and counterparties is lagging information and therefore somewhat stale, whether it's historical financial statements, etc. And in some circumstances, and quite often the case, you don't have access to the financial information because it's a subsidiary of a publicly traded private company, and they're asking for credit on their own terms and conditions as potentially a North American or a European entity that has offshore businesses in other sectors or markets. And so that is problematic. And secondly, the proactive and predictive indicators, information, and analytics is something that continues to be evolved, and pulling all of that information together from various sources, whether it's equity markets, whether it's CDS spreads on certain entities, whether it's personal financial information for those smaller companies, and getting a holistic view of what's happening in that company's world is challenging at best for anyone. So at the end of the day, you have to continue to work through and develop the infrastructure and tools to build out that credit capability, and that sometimes also includes contracting with third parties for third-party data sources to help supplement what you might be getting strictly from the customer or the vendor.
Yes, okay, thank you. Scott, can I bring you in here? Because you've sort of highlighted the dangers of banks lending based on, for example, inflated reserve figures. What's your ideas on how that situation can be improved, how the data that the banks are lending on can be improved, I guess?
Yes. Well, I guess if for a reference, if people want to read a bit more about it, the Wall Street Journal wrote an article on banks getting tough on shale loans as forecasts flop. It was written in December 23rd of 2019, Wall Street Journal. And it does capture and discuss exactly what you're speaking to, and that is that some banks have been loaning on reserves, and this is like a senior debt before bonds and things like that. So this is pretty central to funding operations. But they have been, some banks have been discounting valuations for loans and their loan risk on their own loss experience, as opposed to relying directly on the valuations provided by industry third-party certified reserve auditors, because some banks have been burned even before COVID because they loaned money for reserves, and those reserves turned out to be significantly less, and some corporations had trouble paying that back. So that's kind of a problem, and I think the key for the industry is to I would like to say that it's to develop the technology improvement necessary to more accurately forecast reserves, which I believe is twofold thing. One is sort of the new science, kind of like the science that I was speaking about that we discovered in years ago about the energy driving oil to production. But the other is the sort of everyday sort of empirical forecasts that were actually invented in 1942 and have been used in widespread nature just as by a lot of people, because you don't have to do any large-scale simulation. You just sort of take early production data and then you forecast a couple of scientifically appropriate math functions through those to make projections. And those reserve estimates, those methods have not been doing well, as evidenced by all of the investment pulling out, all the capital pulling out of the shale industry, for the last year and a half. But it's going to take I believe it's going to take an admission and an acceptance of error on the behalf of the existing technologies before we as an industry can correct our ways and get better and make the necessary improvements in forecasting. And I'm one of the very few lone people trying to promote new technologies to forecast. And the reality is, I guess, in human nature and in corporate America, or just in corporate environment, with pressure and investor pressure and requirements, the industry is really, really reluctant to even acknowledge that they've been over forecasting, even to this day. So I think the key to help, improve the, credit risk for the fundamental source of debt fueling, our activities is the reserve-based lending, and the industry really sort of needs to accept that we've been wrong, and we're still struggling to do that collectively. We're still denying the Wall Street Journal. They wrote like 11 articles over the course of 2019, putting forth a lot of evidence showing how we were wrong. and we're still not really admitting that. And I think this COVID crisis, which is accelerating everything and we didn't go into the COVID crisis healthy, even though the price of oil was where it needed to be according to our estimates, but we didn't go into the COVID crisis healthy. And so, however we deal with the COVID crisis, when we arrive out the end of this problem, which a lot of companies won't be with us, unfortunately, but hopefully we'll arrive with the forecast tools that we need to regain investor confidence and return the profits that we should be and we hoped we would be making by now or before the COVID crisis.
Yeah, and I guess what you're really saying is that a better, perhaps more accurate forecasting is going to make for a better relationship between banks and the trust in those reserve estimates. Moving on from that, could I bring Robert in here, and could you talk about how much analysis do you think companies should be doing themselves when it comes to looking at the credit situation of their suppliers and counterparties?
Sure. Well, I think this actually goes back to the 2008 crisis, when a lot of companies and people witnessed that maybe the credit rating agencies aren't necessarily the best thing to rely on for all your information, that they may have a certain bias based on who's paying their bills. And so even before this crisis, we've seen many of our companies certainly still use those agencies. I won't mention them, but everybody knows who they are, but also building out their own in-house analysis to do not only looking at financial statements, but also interactively engaging with companies to try to get a better understanding of what their current situation is and making those calls and staying up to date rather than just relying on the last quarter's financial statements to try to assess what their credit limit should be. So we've definitely seen a shift more towards more of a hands-on interactive approach rather than just relying on information being supplied by the rating agencies.
Okay, thank you. Roderick, do you have anything to add here? Roderick, you may be on mute, or maybe you don't have anything to add.
I was on mute. I'm sorry. No, I was saying, going back to the polling questions, I think there'll always be a need for and a role to play for the public ratings agencies. I don't see that going away anytime soon. But there are drawbacks to that sort of public company space of available data for assessments. And one of the big drawbacks is just the frequency by which that data is available. Best case scenario, it's coming out quarterly. And so, you potentially have a 3-month lag where things can go wrong and you're not getting near real-time updates on what could potentially be happening in an adverse manner to your portfolio that you can then act on. So we do see a push in the industry for participants to enable their own self-assessments of risk that they then tie and calibrate to the agency ratings. But it allows them to do more frequent analysis of the entities that they trade with, or indeed even their suppliers and vendors if they're so inclined. And enables them to risk tier these entities, but also segment the credit risk sensitivities in the portfolio. So they may be able to uncover that a certain portion of the portfolio is more sensitive to cash flow squeeze, for example. They might find that another portion is more sensitive to pricing of debt. Another one might be more sensitive to asset valuations and so on. So they can better risk assess and tier these entities. But in terms of the real-time nature of things, for example, at CubeLogic, one of the things we're working on is bringing in artificial intelligence and machine learning principles and utilizing available real-time data in the form of social media data, for example, that could give you a sentiment analysis of what's happening in the industry. And by no means are we the only ones doing this, but these types of tools that utilize and leverage the available data out there to produce a more real-time risk assessment is a fundamental change for credit office in particular that's differed from how they've done things on a more infrequent basis historically.
Okay, thank you. And let's move on now to the final topic, which is how the risk officer and trader can gain a holistic picture of credit risk. Glenn, you mentioned this as being, an important, a vital thing to do. So could I ask you, in this current environment when things are changing quickly, how do you keep pace with the credit situation of all the firms that you need to, in order to, get an accurate situation of your own credit situation? Could you just talk us through some of the processes and procedures which maybe have had to change recently?
Sure, thank you. So I think that that's pretty much a three-part answer, but I'll go very quickly. First and foremost, you need a credit infrastructure, a credit system or solution that aggregates information and data across various platforms, whether it's S&P Global Markets, whether it's the rating agency information, whether it's Dun & Bradstreet, you name it, an ability to aggregate information by the potential or existing customer base that you have, and combine that such that you have it also for all of the various legal entities that you may have that are market facing. For example, in NRG's case, we have, in north of 7 brands, consumer, commercial, and industrial facing brands, as well as various business lines that all have different legal entities. So the ability to aggregate and understand what your true portfolio exposure is, both on a gross perspective and then net of any collateral, across all legal entities internally, as well as across the group, if you will, or family organizational structure, where they have the other entity also has multiple entities that are market facing and you're doing activity with in such a fashion. So that's the first point. The second point would be, to supplement that, you also have to have a very good communication channel with the wholesale originators, traders, and other market participants that are in the market on a regular basis, that are seeing names, that are seeing opportunities for business, and do a risk-reward assessment collaboratively with them, such that if there is opportunity to arbitrage in the market or sell a customer something and the credit exposure is significantly higher than what the portfolio average would be, or your appetite, your risk appetite under your policy, you want to be able to have pricing or some sort of credit adder to be able to offset some of that potential risk and work with the traders as well, or the originators on the transaction, to mitigate some of that by reserving for that, if you will. And the third piece is really to the point that made earlier as well, that some of the social media and some of the predictive analytics that are being built and developed is something that we need to harness more in order to get a better understanding of the momentum and the velocity of change in the credit portfolio. Relying on static or stagnant indicators is not going to do your portfolio well. Thank you.
Thanks, Glenn. Thanks very much for everything you fitted in there, because I'm aware that the question could have been an entire seminar on its own. So thanks very much for fitting so much into such a concise space of time. I'm now going to pass over to our sponsor. So Robert Belinsky of Inuit is going to provide a few more details on his company's systems, and then we'll come back and have some, and I'll put some of the audience questions which have come in to the panel. So I'll pass over now to Robert. Thank you.
Thank you, Stella. King, if you want to move over a slide. Yep, you can stay on this one for a second. So just give you a brief overview of Inuit and who we are. We are a global CTRM software company with offices around the world, Beijing, Singapore, Houston, London, and we just opened one up in Tokyo. And we have companies using our software to manage their energy and commodity trading risk, everywhere from market risk to credit risk, settlement throughout Asia, North America, and Europe. So next slide, please. Our system, to Glenn's point, we capture both the market risk and also where we can make adjustments for quality of the customer that you're dealing with. So if you have a higher quality credit risk customer, we could monitor it in a way that allows you to have a greater risk exposure to that customer than one who has a lower quality credit risk and one that you're carefully monitoring, questioning. So system is dynamic enough to capture that and run it through the risk engine and adjust accordingly for the various credit and companies that you may be dealing with. Next slide, please. Typical risk setup for one of our customers is, they look at, what do you want to measure? What are the limits? When do we check credit risk for customers? How do we check it, for breaches and, credit details, and what's the credit risk logic? So as I mentioned before, what kind of logic are you going to apply to adjust for a particular company's credit rating, as well as the market risk that, they may be trading in? Next slide, please. We have a view here of our user-friendly GUI. This is the credit bucketing page that allows you can see that it's got the various instruments that you may be using for a particular customer, whether it's a line of credit, mark-to-market risk, your overall open credit, overdue. In configuration, you could either activate or inactivate any of these and how you want to monitor and check a particular customer. And very, very useful for fine-tuning the system for your various customers. Next slide, please. Within, those various items that you checked, you're going to go and set up all your limits, whether it's, again, for, your unsecured limit, maybe your, indemnity management. We've got storage limit, all the various limits that you're going to set up, and that's going to drive your overall exposure to that customer. So if they've got a certain mark-to-market limit you're going to want to set up with them, or a certain open credit limit, this is where you would set it up in the system. Allows you to, again, effectively track what kind of exposure you're going to have with these customers and what kind of overall trading you're going to be able to do with them. Next slide, please. So you see in the counterparties, this one is, we've got PJM pulled up here briefly, but it's going to allow you in configuration to say, okay, at what point do I want to check with this customer? Do I want to check when a trader puts a deal in and he tries to save it? Are we going to check it? And then also this one is configured to be when any type of logistics or scheduling activity with that customer. I'm also going to check their credit limit and make sure that they're good as well too. You've got many other points within the business process flow that you could run the checks on, but it just, for point of this demonstration, we're just showing the two. But suffice to say that there's many points throughout the business process where you can run that credit check on a particular customer by counterparty. All right, next slide, please. Here's a overall snapshot view of our credit exposure report by counterparties. So you'll see, you've got both the, the limits, the current mark-to-market limit, the open credit, the net open credit limit. It's going to compare those two, and is either going to flag it as being under the limit and keep it, keep it good, or if it's going to be outside the limit, it's going to flag you, and we could either send an alert to your credit manager that we've got an issue, or even by looking at this screen, we could color code it so that issues that, such as nearing a limit or over a limit, we could flag in either yellow or red so that it stands out and you have an issue with a particular company. All right, next slide, please. We also offer the capability to drill down within a various areas. So if you see the overall market, risk you have here, then you pull up the separate window below, and it shows you all the trades that you have for that customer that are making up that particular credit exposure. So very useful, allows you to drill in individually to see if there's one trade that's blowing out the credit limit, or if it's just, hey, that we've got too many trades with this particular customer and we need to dial back. Next slide, please. Just a life cycle view of what what our system does. You have your counterparty that you're setting up the business with. You do your assessment, set your approval limits, and then your trade approvals, exposure. Finally, put it in the overall portfolio management of how you're managing the risk across not just that customer, but your whole credit view of all your customers. Next slide, please. And I'm actually going to finish with this slide, and just want to, we're not just a credit system. Credit is just one small part of what we do. We are a fully integrated commodity trading risk management system that covers everything from deal capture through scheduling, settlement. We also have inventory management, logistical movements across almost any commodity you can think of. We have customers using us for LNG, natural gas, power, crude oil, metals, some agricultural products. You know, it runs a broad range. The system is fine-tunable for all these various commodities, and as I've stated, we have customers in live in production using these across the world, particularly very, very heavy usage throughout the Asian and North American market. And coming up on my time limit here, so I'm just going to cut myself off. I'm going to hand it back for the Q&A session.
Thanks very much, Robert. That was a great insight into the business of Inuit. So yes, we're going to go over to audience questions now, and some have come in, so I will put the first one. I think the first one might be most applicable to Glenn. It's rather specific, so I don't know if you'll be able to comment completely on this. The question is, can you explain what happened last August in ERCOT when day-ahead hourly power was priced at over $2,000? I'm guessing, I mean, I'll leave it to you how specific you can be, how much you know about that. But obviously the volatility, you know, this speaks to the wider question of, you know, untold volatility in electricity prices from time to time, and how that impacts on, you know, contracts and credit. So could I ask you, Glenn, for your thoughts on that?
Well, maybe my response will be more of a generic market response. Where you have a market such as ERCOT that is essentially an energy market, it's not a capacity market. So the expectation is you're going to see some volatility in any market for that matter, where you have forecasted load requirements, forecasted generation, and for one reason or another, and we can go through some of those reasons, you have a disruption in either the load relative to the load expectations modeled by the market operator, or whether you have disruptions in generation that is provided by each of the individual power generation suppliers, if you will. So given the fact that there's, you know, really a matching to the megawatt of each of the, you know, locational nodes, if you will, and it's one of those things where the predictive ability of any modeling associated with forecasting load and generation and combining the two, when weather is a strong and material factor in that, plus you have performance of plant operations, you have, you know, customer demand, usage relative to what is expected and historical, you're going to see some volatility in price based on those criteria, either on the load side, the customer side, or on the generation side, the operations that are serving the load. So, you know, rather than getting into one specific situation, but anytime that you have, you know, substantially hotter weather than expected, and that's been modeled, or customer demand that has been substantially larger than what was expected, and or a situation where you have generation dispatch that may be disrupted because of a plant outage or a forced outage where it was not modeled or expected as well, will create situations where your $30 to $40 price will spike for a 5-minute interval or a 10-minute interval, or even, you know, average over an hour north of a few $100s. Yes.
Stella, this is Roderick. I can add a couple other details to that particular scenario. We had some customers impacted by it. And it was a bit of a perfect storm. It was a very hot day, and actually, I think it spiked to closer to $8 or $9 or $10,000, not $2. The big differentiator from that day versus the day before, which had similar load and similar temperature, was the wind was not blowing in Texas as strongly that day than it was the day before. And so the supply-demand ratio just went out of whack, and ERCOT hit its caps on the price limit. That was the fundamental reason why that particular day was so bad.
Okay, thank you. And now move on to another question, and this is probably the last one we'll have time for. And the question is, what about the venture capital to invest in enhanced cybersecurity systems that protect energy control systems and secure energy equipment that, if compromised, may cause severe disasters and huge losses? So I'm not sure if that question is asking specifically about venture capital as opposed to bank lending that we've been talking about, or whether it's making the point that these sort of cybersecurity systems are, absolutely essential, but obviously cost money. And where does that leave a company from a credit system in order to, spend out to get them, which will then put them in a better situation, but perhaps facing difficulties in actually getting the money to in the first place? So who would like to take that question first?
Stella, this is Roderick. I'll add a couple points here and then leave it to the rest of the group. So it sounded as though the question was specifically related to the energy control systems, or maybe for the grid. In that particular example, those investment dollars are not optional. That's a federally regulated and required condition under NERC SIP rules. That anybody that controls a portion of the US grid must, for national security reasons, have all the necessary cybersecurity infrastructure and processes in place and adhere to those NERC regulations. But I mean, in general, cybersecurity is a major issue for any firms that have any sort of activity today. Almost everything that we do as an economy focuses on data and electronic transfer of that data over sometimes secured and sometimes unsecured networks. And so I don't think we're going to escape the need for strong controls and processes in place. And as the hacker community becomes more adept at penetrating those networks, so must the spending increase on the other side to secure them. As to the specific venture capital requirements to invest, I'd have to leave that to somebody else, though.
Maybe I can jump in here, Roderick. So if you think about cybersecurity, regardless of where the capital is being acquired or deployed, you have to have an overall program that's cross-functional, as well as led by the IT or information technology team in some form, but that is cross-functional, because a lot of the components of cybersecurity relate to human behavior, they're not just technical. So you have to have a very rigorous administrative program. You have to have security program metrics that you're measuring against. You have to have auditability to those programs. You have to have the ability to do data breach investigation reports and provide, escalation up where there are potential threats or have been damage. You have to have proof point threat protection and, an overall strategic cybersecurity roadmap that you're stewarding to, because this is not a static situation. So that roadmap really has to address, any system vulnerabilities, any human vulnerabilities, any intentions to pierce, if you will, the corporate barriers that you have in place, and also monitoring external cyber incidents as well, and learning from what others are seeing and happening in their business as well. Thank you.
Okay, thanks, Glenn. And there's just one more question which we can attempt to answer quickly. I think, Glenn, this might also be one for you. The question is, have you or your company had to institute new processes or procedures around credit monitoring because of recent events? So you've gone into this quite generally, just there's about 2 minutes left. How would you answer that question?
Yes. No, I can elaborate on that a little bit. Shy of 2 minutes, but yes, because the credit process has to be dynamic as well, and has to be fluid, so that when we look at the credit process, there's 3 key areas that you need to be thinking about. One is the overall industry risk for your customer, counterparty, or vendor. The second is, the business risk associated with that legal entity or group of entities, and do an assessment on that. And then the third is, within that business, the financial risk associated with it. So as long as you've got a relatively dynamic understanding of the overall industry risk, which requires, information aggregated on an industry perspective through various predictive analytics and data as well. And then layer in on top of that the business and financial assessments, if you will, on the viability. So they may be very financially viable today, but the business, situation with COVID and the impact on their business may substantially be negative. And then what's the implications and where they position themselves in the overall industry will drive, fairly dynamic decisions around credit. Then the question is, do you want to do the business? Do you get it by way of pricing? Do you reduce the risk by way of collateralization in some form or other contract mechanisms to protect the capital of the company? Thank you.
Okay, thank you, Glenn. And we are unfortunately up to time now. So it just remains for me to say thank you so much to our 4 panelists for all your views and insights into this very important topic. And thank you to everyone for listening. And please do join us for next week's webinar as well. Thank you very much.
Thank you.